In the United States, two people can have identical incomes, identical credit scores, and identical financial goals and experience the financial system in completely different ways. One of them moves through it almost frictionlessly. Mortgages get approved, car loans close in days, credit applications take minutes. The system reads their financial life clearly and responds with confidence. The other one encounters friction at nearly every step. More documentation requests, longer underwriting timelines, conditional approvals, qualification figures that don't match what they actually earn, and explanations from loan officers that never quite account for the full picture. The difference between these two people isn't discipline. It isn't financial sophistication. It isn't even income. It's a three-letter designation on a tax form. One of them receives a W-2, the other one doesn't. And that distinction, one that feels administrative, almost trivial, runs deeper into the architecture of the American financial system than most people realize. It's not a bias. It's not a policy preference. It's the result of a system that was designed around a specific model of work at a specific moment in economic history and has never fundamentally restructured around the workforce that exists today. To understand why the system works this way, you have to understand when it was built and what it was built to solve. The modern American mortgage system took its current shape largely after World War II. The Federal Housing Administration, which had been created in 1934 to stabilize a collapsing housing market, expanded dramatically in the post-war period. Fannie Mae was restructured. Freddie Mac was eventually created. The secondary mortgage market, the system by which loans are sold to investors after origination, was formalized around standardized underwriting criteria. The workforce those criteria were designed around looked very different from today's. In the post-war era, the dominant employment model was long-term salaried employment at large institutions. You got hired at a company or a government agency. You received a consistent paycheck. Your employer withheld your taxes, contributed to your Social Security, and verified your employment status through institutional channels. Income documentation for that workforce was simple. The W-2 summarized your annual earnings in a single, standardized number. The pay stub confirmed your monthly contribution. The employer verification letter confirmed you still worked there. The underwriting models built during that era were calibrated to that documentation. They were designed to read W-2 income cleanly, efficiently, and with high confidence. The system worked well for the population it was designed around. The problem is that the population it was designed around no longer describes the full American workforce. The independent workforce freelancers, contractors, consultants, small business owners, gig workers, sole proprietors has grown substantially over the decades since those underwriting frameworks were established. The IRS processes tens of millions of Schedule C filings annually, representing self-employment income across virtually every professional category. But the core documentation logic of conventional mortgage underwriting, the Fannie Mae and Freddie Mac guidelines that govern the majority of American home loans, still centers on the W-2 model. It still evaluates income primarily through tax return net figures. It still uses the same debt-to-income calculation methodology. It still applies the same income stability requirements that were calibrated for salaried employees. The workforce changed. The framework didn't. And the gap between them is where millions of self-employed Americans encounter friction that their W-2 counterparts simply don't experience. If you want to keep building this kind of structural understanding, the historical and mechanical foundations of how American financial systems actually work, subscribe. That's what this channel is built around. Let's trace the specific mechanisms that make the W-2 advantage concrete, because it's not abstract, it's mathematical. A salaried employee earning $95,000 annually applies for a mortgage. The underwriter requests W-2s and pay stubs. The income figure is clear, $95,000 divided by 12, monthly qualifying income is approximately $7,917. The debt-to-income calculation proceeds from there. A self-employed consultant earning $95,000 in net self-employment income after deductions applies for the same mortgage. The underwriter requests 2 years of federal tax returns and reviews Schedule C. If year 1 showed $78,000 and year 2 showed $95,000, the 2-year average is $86,500. Monthly qualifying income, approximately $7,208. Same net income in the most recent year. Materially different qualifying income under the underwriting model. The averaging mechanism, which exists to smooth income volatility, pulled the qualifying figure below the current year's actual earnings. Now add the deduction effect. If that $95,000 net figure was reached after the consultant deducted $45,000 in legitimate business expenses from $140,000 in gross revenue, the underwriting model has no mechanism to credit the borrower for that context. It reads the net figure and runs the calculation. The W-2 employee's $95,000 salary faced neither of these compressions. Their qualifying income is their income. The self-employed borrower's qualifying income is their income after averaging, after deductions, a figure that may represent significantly less than their actual economic output. The tax system reinforces this divergence in a way that creates a structural bind. The U.S. tax code extends significant deduction advantages to self-employed individuals precisely because they bear costs that employers absorb for W-2 workers. Health insurance premiums, retirement contributions, half of self-employment tax, business operating expenses, these are all deductible because they represent real economic costs of self-employment that don't exist for salaried workers. Those deductions are economically justified. The policy rationale is sound. But every dollar deducted for tax purposes is a dollar that reduces the Schedule C net income figure the mortgage underwriting system uses to evaluate borrowing eligibility. The tax code and the lending system share one document, the federal tax return, but they reward opposite outcomes from the same input. The self-employed borrower who follows optimal tax strategy produces a tax return optimized to show the IRS the lowest legitimate taxable income. That same return is then used by lenders to evaluate maximum borrowing capacity. The borrower who plays the tax game correctly, by the rules the system provides, produces documentation that disadvantages them in a parallel financial system. That's not a coincidence. It's an artifact of two regulatory frameworks that were built for different purposes and never reconciled. The W-2 system has a third structural advantage that rarely gets discussed: employer verification. When a salaried employee applies for credit, the lender can call or submit a written request to the employer's HR department to verify employment status, length of tenure, and income. The employer, a corporate entity with legal obligations and institutional infrastructure, confirms the information. That verification layer gives lenders an external check on the borrower's income claim. It's a second data point beyond the tax return, and it comes from a source with accountability. A self-employed borrower has no equivalent external verifier. They are the employer. Their income documentation consists of tax returns they prepared, profit and loss statements they generated, and bank statements that show deposits, all self-originated. Lenders compensate for the absence of an independent verifier by applying more conservative qualification standards and requesting more extensive documentation. This is rational risk management from the lender's perspective, but it produces a systematically different lending experience for a borrower who may be equally or more financially stable than their W-2 counterpart. Some of this gap has begun to close. Bank statement loan products, which calculate qualifying income from 12 to 24 months of actual bank deposits rather than tax return net income, give lenders a more direct view of cash flow. Profit and loss-only loan programs exist at some portfolio lenders. The non-QM lending space loans that don't conform to Fannie Mae and Freddie Mac guidelines has developed products specifically designed for self-employed income structures. But these products carry a price. Interest rates on bank statement loans typically run higher than conventional loan rates. Down payment requirements are often larger. They reach fewer borrowers at fewer institutions. The alternative path exists, but accessing it costs more often over the entire life of the loan. The system offers a solution to its own structural gap. The solution comes with a premium. Step back and look at the full picture. The American financial infrastructure, mortgage underwriting standards, consumer credit evaluation, income verification methodology was architected around a workforce model that made sense in 1950 and reflected real economic conditions through much of the 20th century. That model assumed that most workers received consistent salaries from stable employers, that income was predictable and externally verifiable, and that the W-2 was a reliable summary of financial capacity. Those assumptions still describe a significant portion of the American workforce, but they no longer describe the whole of it. The independent economy, which encompasses contractors, freelancers, gig workers, small business owners, and the full range of non-W-2 income structures, represents a substantial and growing share of American labor. The financial infrastructure those workers navigate was not designed for them. It has been adapted partially at the margins. But the core logic, the income documentation requirements, the qualifying income calculations, the verification standards, still centers on the employment model that was dominant when the system was built. The self-employed American who struggles to qualify for a loan isn't encountering a broken system. They're encountering a system that's working exactly as designed for someone else. That distinction matters, because the solution to a broken system is repair. The solution to a mismatched system is understanding the mismatch clearly enough to navigate it deliberately. The W-2 advantage in American lending isn't an intentional policy choice to favor employees over entrepreneurs. It's the residual imprint of a historical moment on a set of institutional frameworks that updates slowly. Here's the question that I think deserves more public discussion than it currently gets. As independent work becomes a more permanent feature of the American economy, not a trend, not a transition, but a structural characteristic, at what point does the financial infrastructure have a design obligation to reflect that reality? Leave your perspective in the comments, especially if you've navigated this system from the self-employed side, because the accumulated experience of people who have lived inside this mismatch tells a story that the policy conversation around financial inclusion rarely acknowledges clearly enough.